We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Gary Savage, retired entrepreneur, stock and commodity trader, and founder of the Smart Money Tracker Premium. Gary, how are you today?
I'm doing good, Tom. Thanks for having me on again.
Always good to have you, Gary. And I think the important thing to start talking about with you is the idea that something you and I have touched on several times, the idea that we always need to keep this bigger picture in perspective. Obviously, with gold right now, we're seeing a big run up. A lot of investors are getting excited. Some are getting, maybe being cautious because they maybe feel the market is overbought. And I think we can go through all of those ideas today. But when we see gold rising day over day, making higher lows, higher highs, what's important to keep in perspective from the bigger picture here?
So with my analysis, cycle analysis, the biggest picture is the 8-year cycle. That 8-year cycle bottomed in October of 22. It's my opinion that we'll probably get the final bull market, the kind of the parabolic bubble top during this 8-year cycle. So the move needs to start to get aggressive, which it is. And my best guess is we've got 2 to maybe 4 years left. And then this 8-year cycle will top in that vertical move higher. And then, as all bubbles do, they'll collapse, and then we'll have a 20, 30-year bear market after that. But I think the time has come, and the 8-year cycle's lined up. The intermediate cycles are doing what they need to do. They're making higher highs and higher lows. Where the price appreciation is starting to get aggressive, as it should, as we enter what I think is this final run up. So everything is lining up. Now is not a good time to be bearish, in my opinion. I would advise people to maybe convert to the weekly charts and a 10, 15-year spread on your chart, so you can keep the big picture in mind and don't get distracted by a down day here or there, or even a multi-week intermediate correction. Doesn't change the big picture. The big picture is that new 8-year cycle, probably going to get our final top during this 8-year cycle. Things are going to become more and more aggressive, I think, as we get further into this cycle.
So why don't we look at that gold chart, Gary, from that weekly time frame, and explain to us a little bit more about this, let's say this 8-year cycle. So that includes basically a bottom into a top, and does the full cycle include another bottom, or is that just a bottom to a top?
So yeah, cycles are measured trough to trough.
Okay.
Here was our last 8-year cycle low.
Let's say in about October, November 22.
Well, I guess maybe it was the first day of November. Anyway, end of October, beginning of November of 2022. That was our 8-year cycle low. That was that handle for that large cup and handle pattern. So here was the top of our last secular. This has been an entire secular bull market. So this is a cyclical bear market. Mm-hmm. But this is that cup and handle pattern. And our 8-year, here was our previous 8-year cycle low at the end of 2015. It did what it needed to do. It made higher highs, higher lows, and then we get our 8-year cycle top, and then we evolve into this handle for this cup and handle pattern, and we get our 8-year cycle low right in the middle of that handle, and then we get the breakout, and you can see that this move, when you're looking at the big picture, has become very aggressive, which is exactly what we should expect if this 8-year cycle is going to include that parabolic move to a final top. That I think 7,000 is a piece of cake, and I think 10,000 is probably likely. And everybody knows I've made this prediction many times. $100 silver is going to be a piece of cake, and 250, maybe even $500 silver isn't out of the question. Now, this doesn't mean, people want to assume that this means it's going to be easy. It's not going to be easy. It just means it's going to get there. And as this move matures, it's going to get more erratic and more volatile, harder to hold on to the bull. So, if you're expecting easy, you're going to be disappointed. It's going to be very tough to ride this move. But everything is telling me that this breakout here has kicked off this is the initial start to the final parabolic move that'll put in a top to this 25-year bull market in metals.
Well, I was reading through a couple of your posts, and you were saying that metals are going to be an easier place to be because of the volatility that many of these other markets are going to be experiencing. So is that, comparatively, you're saying that this bull is going to be hard to hang on to in gold and silver, but at this point, it's going to be easier than the rest of the markets, right?
No, it'll be harder.
Okay.
The moves will be bigger percentage moves because it's a thinner market, but I think the volatility is going to infect everything. As bull markets get more mature, they start to get more volatile. We're kind of seeing that in the stock market. I mean, that bull market in stocks is 16 years old, so it's really mature, and you can see we're starting to get volatile in the stock market. When markets get stretched too far above their long-term moving averages, they tend to get volatile because smart money, big money traders get nervous when price stretches too far above the mean. It's at risk of a regression event back down. It's kind of the opposite of like retail traders that are kind of unsophisticated. They become more confident. The longer something goes up, the more confident they become that price can never go back down. Whereas somebody that's been in the market a long time, knows what they're doing, they get more nervous. And so there's more of a tendency for that big money to want to take profits. And then the smart money that thinks the coast is clear, they want to buy those dips. And so you start to get these wild, erratic moves, big percentage moves. At that final bubble top in the NASDAQ, we had periods where in like 3 days, the NASDAQ would fluctuate 10, 12, 15% in 3 to 5 days. That's some extreme volatility. We're going to get that in the metals, and it could be worse because the metals are just a smaller market, and so they're more volatile. Doesn't mean the bull market's over, although it's going to look like it, especially if you're maybe an inexperienced retail trader. You see a 5 or 7% move down in gold, and you panic and you think, the bull market's over, and it's not over. It's how the bull throws people off during the final years of the move as we start to go parabolic. So it's not going to be an easy ride. It's going to be volatile. It's probably going to be volatile in everything. Stocks are going to be volatile. Bitcoin's going to be volatile. Energy will be extremely volatile once it bottoms. I think it's in the process of trying to complete an intermediate degree decline, and then energy will start to rise again as well. But that's probably going to be later this summer. Mm-hmm. So, not going to be an easy ride, but it's going to be a very profitable one.
Right. Gary, when we're looking, maybe a little bit closer in at the chart here, is it important to be looking or to be considering momentum as well when we're looking at these trends?
Well, you can see the momentum that has developed as we came out of this triangle consolidation here. This is a weekly chart, by the way. Pretty good momentum. Somewhere here, we're going to have a correction into a daily cycle low, and maybe it started here. I'll convert over to the daily charts. Hard to say. We hit that 2,900. That's obviously a psychological resistance point. It could be a spot where we pull back into a minor daily cycle low. And you can kind of see here, I've drawn the trend lines in. a little different than what we normally would expect out of an intermediate cycle decline. Usually you'll get an A wave down, a B wave bounce, and then a C wave that makes a lower low. But we're not getting that because gold has been suppressed for so long. So instead, we're transitioning into these sideways churns. And in this case, it turned into this triangle. And then once we broke out of the triangle, pretty aggressive move higher. So somewhere in here, we'll get a daily cycle low, and that usually lasts 5 to 8 days. That'll panic retail traders. Emotions will come into play, and they'll start to assume that the gold is topped, and we'll start to hear comments about silver's crap and miners are crap, and I'll never buy it again. And that's the cleansing that allows for the next leg up to begin. And we've still got multiple weeks before this intermediate cycle is going to top. The MACD on the weekly chart has just now crossed over, so we've got probably 6 to 10, maybe 12 more weeks before the intermediate cycle tops. There's signs I look for that tell me it's time to start dancing close to the door on your short-term positions. Now, like on things like physical, I don't sweat these corrections in physical. I don't doesn't bother me a bit. I don't get my calculator out and calculate how much my physical is worth every other day, like you do when you're looking at your portfolio. When you open your trading account and you immediately look to see what's the value today. Gold's down a percent. How much money have I lost, or what's the drawdown? You don't do that with physical. And so my recommendation for most people, especially retail type traders that are prone to making emotional mistakes, is have a big chunk of your capital in physical, and you'll be there for the whole ride. You won't miss anything, and you won't panic during these intermediate and daily cycle corrections.
Mm-hmm. Is it possible that silver is not really following gold at this time because of the different demand characteristics of the metals being, let's say, predominantly monetary versus industrial, respectively?
No, I don't think that's it. I think a lot of it is just there's a lot of short side money that's at risk, and they're I'll pull up the chart of silver. They are desperately trying to hold that suppression at $33 right here. They do not want silver breaking out above $33. As we discussed earlier, I looked at the COTs yesterday or day before anyway. I think there's still about 96,000 contracts short. Now, some of that is miners hedging their production forward, but a lot of it's just the bullion banks, and they're trying to keep the price of silver. They want to keep it below this $33. Once it breaks through that, they're in trouble, and they're going to have to start covering. I noted back in March of last year when they could not drive gold, they couldn't hold the suppression below 2,000. I warned people it was going to trigger a short squeeze in gold, and it did. And gold went from 2,000 to 800. So it triggered an 800-point short squeeze in gold. Same thing's going to happen here with silver when this suppression breaks it. And I think it's going to break at 33. I mean, you can just see they are desperate to keep silver below that resistance zone here. So my feeling is 33 is the line in the sand. When that breaks, and it will break, they're not going to be able to hold it. Then we're going to get a short squeeze in silver, similar to what happened in gold. So that's why I say $40 is going to be a piece of cake during this intermediate cycle. And I'm looking for a top maybe as early as late March, more likely probably mid to late April. I'll give myself enough time. Mid to late April is what I'll say for this move to occur. $40, I think, is going to be a piece of cake. I think 45 is likely, especially if we get a short squeeze started here. And $50 isn't out of the question. Now, that's a little bit of a long shot, but if you get a really big short squeeze going, $50 isn't out of the question. But I think $40 is a piece of cake. Mm-hmm. So I think you want to be in before this this resistance zone breaks. Right. So anywhere down here you got to get in now, because when this breaks, it may break as a really big 3, 4, 5% up day when this breaks. When the shorts have to just all of a sudden give up and start covering, you could have a 5% up day. You don't want to have to buy after that. So I think you want to be in now before it breaks.
Mhm. Gary, what makes what informs your, let's say, your opinion of the timing for that? Like you're saying March to early April, mid-April. What informs your timing on that move?
So it's based on the normal timing band for an intermediate cycle.
Mhm.
And let me go back over to gold, because gold is the cyclical driver of the precious metal sector. So all of the uh, timing counts are based off of gold. Now this is going to be a little bit different, um, because we got a triangle. So cycles don't work very good in triangles. Normally we would, as I explained, we'd get an ABC move. We'd get a wave down, a B wave bounce, and then a C wave that makes a lower low. And then the C wave, that's your intermediate cycle bottom. And that's where your count starts from, your weekly count. But because this trend or formed as a triangle, we didn't get that lower low. We didn't get that C wave. But this is our intermediate cycle low right here.
Mhm.
So now let me switch this over to weekly. So
It was like
our
mid-December.
yeah, so our intermediate cycle low was, I guess it was here. So this is where you'll start your intermediate count. So we got 1, 2, 3, 4, 5, 6, 7. Although I think this is it. So I think we're on week 5. And I think that corresponds with where we're at in silver and miners too. They're on either week 4 or 5.
Mhm.
So a normal intermediate cycle runs trough to trough, runs somewhere between 20 and 25 weeks. If you're in a bull market, the cycle will right translate. That means it should rally more than half the distance. So let's say normal would be 22 weeks. So halfway would be 11 weeks. So you would expect in a bull move in the advancing phase of an 8-year cycle, intermediate rallies are going to rally at least 12 weeks. They're going to right translate. So they're going to continue to rally past the midway point. So 12 to 15, maybe even as long as 18 weeks would be about where we would normally expect the rally to go before it tops. And then you'll have a certain amount of weeks for the declining phase of the intermediate cycle to find that trough and bottom, and then the next, then it repeats, and then you get another leg up. So if we're 5 weeks into this, we should have at least 6. We should have at least 7 more weeks to go, and we probably got about 10, maybe 10 to 12 more weeks to go. So that puts us out into late March.
Mhm.
Early mid-April at least before I want to look for a top. And then there's other things also that I'm looking for. Some breadth, how the miners are behaving, whether they're starting to diverge, what the gold silver ratios are, what the ratio of the gold XAU is, the bullish percent index. A lot of other things to tell me that it's time to start dancing close to the door. But right now we should still have 7 to 10, 12 more weeks to go before we need to worry about an intermediate top. Now, like I said, we will get some shorter term tops, daily cycles, something that's going to correct for 5 to 8 days, but not something that's going to correct for 5 to 8 weeks.
Right. Gary, you touched on the gold to silver ratio. Do you use that, just to inform where we are on these cycles, or is it something that gives you more information than just cycle timing?
It's something that tells us, or tells me that we're getting late. Well, when the ratio starts to drop or starts to increase in favor of silver,
Mhm.
Silver tends to move late in a cycle. During the early part of a cycle, you got smart money. Institutional investors are coming in. They're going into gold, so gold moves first. And then towards the end, as people become more and more confident, that price can never go down, gold's getting expensive. They're looking for something a little cheaper to buy, and silver is the obvious choice. And so you're starting to get more capital flowing into silver. It's a thin market, starts to moves big. Instead of getting a 1 to 1.5% move in gold, you start getting these days where silver is going up 2.5, 3, 4, maybe even 5% on a day. And so that's that period where the gold silver ratio is really starting to accelerate in favor of silver. But that's also telling you that you're late in the intermediate cycle, and that sentiment is really starting to swing towards an excessive bullish position, something where you're at risk of running out of buyers. And then you'll get, usually you'll be stretched a little bit too far above the moving averages. Smart money will start to get a little nervous. They'll start to take profits. And then price starts to go down when the big money starts to exit. And then stops start to get hit. And as more and more stops get hit, self-fulfilling pattern, more and more selling comes in. Sentiment, again, starts to turn negative. If this lasts for multiple weeks, then people become very bearish, and they start to assume that since price has been going down for 8 weeks, that means it can never go back up. And then at some point, the exact opposite happens. You run out of sellers, bottoms, fundamentals take over again, and we turn and go back up. And that's what has happened here in gold. It happened as a triangle pattern in gold. In silver and miners, it happened as a normal A, B, C move down in silver. Same thing in the miners. In an A wave down, B wave bounce, C wave down. Everybody's negative, never going to buy miners again. And, we run out of sellers, and then look what happens. Down here, people were telling me that, I was an idiot. I was, crazy for thinking that miners could ever make a higher high. But, that's what bull markets do. I've tried to impress this on people over and over and over. Bull markets, by definition, make higher highs and higher lows. When we're in the advancing phase of an 8-year cycle, you expect higher highs and higher lows. And so when people down here are telling me that miners can't make, they can't go back above $45, well, that's ridiculous. We're in a bull market. They have to go back above $45 because the bull market makes higher highs. And here we are. We're on our way. We're gonna make higher highs at some point. And once everybody gets overconfident again, then we'll come back down, and we'll do the same thing as we did back down here. But the low will be higher. We won't come back down to this low here. Maybe we'll go to $50 and we'll come back down to $40. It's the same thing repeating over and over, but people get lost in the daily charts, and they don't, they lose track of the big picture. The big picture is we're in a bull market, end of story. Bull markets make higher highs and higher lows. Mm-hmm. And there's, that's exactly what the metals are doing. So there's absolutely nothing wrong with the metal complex. And as we are, in what I think is the final 8-year cycle of this bull market, things should get more aggressive, but also more volatile and more erratic as we progress. So harder and harder to ride this bull market.
Mm-hmm. You're mentioning, basically gold goes first, then silver, then the miners. What miners market do you look at to understand, let's say, the structure or let's say the tick boxes of this entire market?
Actually, silver and miners are a little bit strange. Sometimes they will kind of lead out of the bottom, and then usually they'll diverge at the top. But big picture is like miners and silver kind of go hand in hand. I do think silver is going to outperform over the remainder of this bull market. So, if you're looking for outperformance, I think, say outperformance over the next 4 years, I think you just want to be in silver. I think silver will significantly outperform the mining stocks. Not every mining stock. There'll be a few that'll go, nuts and produce 10,000% gains. But, what are your chances of picking that one or concentrating your portfolio in that one? So if you're looking for outperformance that's going to last over 4 years, I think silver's your place to be. Mm-hmm. generally speaking, the intermediate cycle, silver and miners will outperform gold, but gold will probably lead. One of the reasons it's going to lead is because it broke the manipulation, and but silver and miners haven't yet. So people, when I say silver's, um, I think is on the verge of breaking the suppression. Well, they say, well, you already said the suppression was broke. What I said was the suppression is broken gold, and that's why we had that 800-point short squeeze. It hasn't broken in silver yet, and it hasn't broken in the miners yet. I mean, gold is at 2,900. Do you realistically think in 3 months the fundamentals for the miners have changed so much that the sector is still way below the previous intermediate top? No, it hasn't. It's just the sector is being shorted heavily. The banks can short the mining stocks with impunity, whereas there are contract number or rules in gold and silver, so it makes it harder to suppress without getting fines. Um, so it's been my opinion the suppression in the miners will be the last to break, but it will break as well. Mm-hmm. And we'll have some really outsized moves in the miners as well. But I think the one that's going to break next is silver, and I think it's going to break at 33.
Gary, do you think it's really hard for those that have watched this market for, let's say, the last 10 years to break this recency bias of the metals being broken?
Very, very hard. People are just, that's just human nature. When something has gone up for 3-4 months in a row, uranium was we talked about this a little bit before we started recording. Uranium is a good example. Went up for whatever it was, 2 years. And so people assumed that because it had gone up for 2 years, that there was some fundamental reason why it couldn't ever go back down. Mm-hmm. Tried to warn people that all markets correct. It doesn't matter what the fundamentals are. It has to do with sentiment, not fundamentals. And sure enough, uranium has been correcting for a year now. So, it's just sentiment driven. I kind of lost my train of thought there. What was your original question?
Breaking this recency bias.
Oh yeah. So it takes some weeks for that to break. I think we're still in the process of getting rid of the fear that was generated during this. I think this took about 11 weeks, moving down. So people are still cautious. They're still nervous here. But I'm going to say once we get through our first daily cycle low and then we start up and we make another higher high, that will start to go away and we'll start to build that bullish sentiment where people start to assume that something has changed fundamentally and now it's safe to buy back in and that price can never go back down. And once you get most of the traders on that train, then that's when you kind of run out of buyers and then you'll get that multi-week intermediate top. But in order to do that, you have to make a higher high to really get everybody bullish. And you'll still have a lot of traders that are in that mentality that they want to buy breakouts. Usually doesn't pay off very well for people because unless you're getting into that final parabolic phase where you get a breakout and then you go 100% above the breakout, most breakouts don't go all that far. They'll go maybe, I don't know, 10, 15, at max 20% above a breakout, and then you get an intermediate top and then a multi-week intermediate correction. So buying breakouts isn't a great strategy until you get to the very end of the bull market where the market is ready to go parabolic, and then you'll get a breakout and it'll go 100%. Mm-hmm. That's the breakout where we go from $100 silver to $500 silver, or $250 silver, or whatever. But right now, I think we're still in the stage where we're still getting normal intermediate corrections, and so it's better to buy these bottoms than to wait around and buy breakouts.
Better to buy the bottom when you feel like this thing is broken and it's never going to work and it's just such a pile of junk.
when you've convinced yourself that price can never go up and it's impossible for you to click that mouse, call your wife into the room and have her help you click the mouse, because that's the time you need to click the mouse.
Gary, you and I also touched on this idea of fundamentals versus sentiment, or fundamentals and sentiment, before we hit record. I think that's a really interesting idea to explain. This idea that fundamentals matter for, let's say, the background driver of a market, but it's only when sentiment matches that it actually accelerates.
Yeah. So fundamentals are kind of the main driver of the bull market. But then sentiment drives the shorter and the intermediate term. So at some point, like I said, when you get up here, intermediate sentiment gets a little too bullish. You're kind of running out of buyers. We're stretched maybe a little too far above the moving averages. The smart money is getting a little nervous. They start to take some profits. Then you get an intermediate decline. Down here, sentiment gets a little bit too bearish. You run out of sellers. The fundamentals take over again. The smart money that maybe took profits up here, now they're starting to buy again. So the fundamentals are driving this move out of the 8-year cycle low. They're driving price higher. Sentiment is what is driving these stair steps up and down, as it becomes either too bullish or too bearish. But the fundamentals are going to drive the move until we get to that final parabolic move towards the very end. And usually what happens is the fundamentals have already reversed, but sentiment will continue to drive price into that parabolic top. Just people have just become convinced that since price has gone up for 15 years, that means it's always going to go up, and they'll find an excuse for why the fundamentals are stronger now than they've ever been. A classic example was back in, was it 2008 or 2009, in oil. Oil had been going up and up and up for years, and people were convinced that oil could only go up to $200 or $250. And at the time, we had so much oil that tankers were setting in the Gulf with no place to unload their oil. Everything was full. But people were assuming that the fundamentals were driving oil higher. It wasn't the fundamentals driving it. The fundamentals had already died, a year ago. It was just sentiment that the market had gone up for so long that people had just assumed that was, that there was some fundamental reason driving it, so they had to keep buying. And you get that big parabolic move that then collapses. When reality takes hold, it's like, hey, wait a minute, what are all these tankers setting out in the Gulf of Mexico, all full of oil, and they can't unload it anywhere? Maybe I got the fundamentals wrong. Same thing's going to happen for gold. The dollar will have bottomed or whatever, and inflation will be turning back down, but people will drive gold to insane levels just because it's the move has been going strong since the breakout last year in March of 23. That's when it started, and they will convince themselves that inflation's going to be here forever. And but it won't. It will have already turned and gone back down. But sentiment will drive that parabolic move. And when you see that, it'll be the hardest thing you got to do. You got to, at some point, you got to say, I got to control greed. I've made enough money. Got to sell before that last chair gets pulled out and I get caught in the crash.
So Gary, are oil and uranium, like you've been mentioning, basically energy, are they that related that we should be looking at them somewhat together or as a pair?
I think they are. I think when oil really starts to move to the upside again, it's basing right now, but when it really starts to move to the upside again, then I think uranium will follow it higher. But until that time, I think uranium itself is still stuck in a downtrend. The uranium miners are stuck going sideways, just like the energy stocks like XLE has been stuck going sideways for a couple of years.
I want to get a little bit of, again, kind of zooming out and looking at this larger picture, Gary, with all the, let's say, the shock and awe of the first couple of weeks of Trump's second term here, is part of keeping perspective on this bigger picture, understanding still the debt problem, the health of the economy, and let's say where the Fed is at in terms of monetary policy.
I think that's probably the fundamentals that are driving gold. I mean, we just printed, the world printed trillions of dollars after COVID, and that's still sloshing around. A lot of it, obviously, a lot of it went into the stock market. A lot of it went into the commodity markets. We got a final secular bear market bottom in 2000 in the CRB, in the commodity index. At some point here, I think the stock market, like I said, we're 15, 16 years into this bull market. It's pretty mature. I think more and more liquidity is going to come out of stocks and start to go into commodities. And it doesn't take a whole lot of that to go into gold to get that final move. I think we got another round of inflation's got to hit. It usually unfolds at least as two waves. We had the first wave coming out of that 2020 bottom. And now we're kind of oil's, pulled back from the high in 22 and it's basing. Gold is leading. It's already broken out of the handle, so it's leading the commodity complex. But I think we need one more inflationary phase, and then we'll get a top, and then we'll probably have a multi-year bear market and maybe a golden age where inflation is under control like it was in the 80s, or the inflation goes into the stock market again. But we'll need to have a bear market in the stock market as well, a long-term bear market like we had from 2000 to 2009.
Mm-hmm. Before we get that next move up.
Before we get another secular bull market in stocks, we're going to have a secular bear market. And since the bull market's getting pretty mature at 16 years, we're at risk of a top here somewhere in the not too distant future. And when that happens, I think some of that liquidity that's in the stock market will start to flow more so into commodities. Liquidity is flowing into everything. Everything's going up and has been since 2000. But once the stock market tops and stops making higher highs, then I think more liquidity will flow into the commodity markets. And maybe during the second phase, maybe gold tops first and energy tops second. So we might get a top in gold. Let's say we got 3 to 4 more years maybe. So we top in maybe 27 or 28 for gold. Maybe energy keeps running into, oil makes its top at $200, $250, but maybe it runs into like 29 or 30, and then we're done with the commodity bull market.
So at this point in time where we are, Gary, it doesn't necessarily really matter where the Fed is at. You're not paying attention to that because you're just measuring the cycles and keeping that longer term perspective.
I think they can't change the fundamentals. They can't take back all that liquidity that every central bank has printed. They can't all of a sudden shrink the debt. The whole world is in debt. And the only way to service that is to continue to print money. So they can't change those fundamentals, and that's going to be the ultimate driver until we get into that final phase where it's just pure sentiment driving price to crazy extremes to the upside. But the fundamentals are still intact. They've been intact since 2020, and they're not going to reverse anytime soon.
Perfect. Well, Gary, I appreciate you running us through your thoughts on this longer term perspective today. I think it's really important to really keep that in mind and understand that recency bias, understand, holding your nose when you don't want to buy something. I think those are all really important points that we need to consider here. Is there anything that you'd like to leave our listeners to think about before we wrap up here?
Oh, right now we're just watching that $33 in silver. When it breaks through that, I think it's game on. And like I said, I think you want to be in before it breaks, because it may break with a big short squeeze that could, you might be trying to find some way to chase into a 5% move. So right now, I think that's where the potential is building in silver, and I think you just want to get in before it does break.
And I guess once we see that, let's say that intermediate cycle top, Gary, what kind of timing do we, let's say, anticipate for that topping pattern or that new low of that intermediate cycle change before we, let's say, not pick the bottom, but understand that timing probably shows us that it's over?
Yeah. So like I said, the average duration for an intermediate cycle, trough to trough, is between 22 and 25 weeks. So once we get the top and we're 20 weeks in, then I move down to the daily cycle count and I see where we're at. The daily cycle usually runs about 35 to 45 days trough to trough. And so, once we're in the timing band for the intermediate cycle bottom, and then we're also in the timing band for the daily cycle to bottom, I start looking for other things to tell me that it's, maybe the bottom. And, here's a mistake a lot of people make is they worry about trying to pick the exact bottom, and you don't have to pick the exact bottom. As I've said several times here, bull markets make higher highs. That's the definition of a bull market. So you could literally buy at the exact top of the intermediate cycle and have to ride down a 12-week correction. You still got a winning trade. Why? Because the bull market's going to make higher highs. Right. So the next you've lost some time, and you've lost some potential. Whereas if you could have sold the top and bought the bottom, you'd make more money, but you're not going to have a losing trade. The bull market is going to make higher highs. So people get very nervous about trying to time a perfect entry at an intermediate bottom when a perfect entry isn't required. All you got to do is just get close enough. If you get close enough, you're going to make great money during the market.
Excellent. Well, Gary, again, I appreciate you giving us that perspective. For those that want to see more of Gary's work, that's all available at smartmoneytrackerpremium.com. And of course, excellent Twitter follow as well at Gary Savage1. Gary, thanks so much for your time today.
Thanks again for having me on, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.